Hello and welcome to another episode of Angel Insights brought to you by SyndicateRoom. This is the show that delves inside the world of early stage investing to reveal the tips, tactics and strategies of some of today's best investors. And joining me today on the show is Deb Kemper. Now, Deb is the managing director of the Boston chapter of Golden Seeds. Her involvement includes deal flow, membership, education and operations. And she's an active early stage investor and mentor to entrepreneurs as well as being a board member. Prior to Golden Seeds, Deb spent many years in management consulting at McKinsey, where she served clients in the healthcare, energy, and electronic space. But without further ado, I'm delighted to hand over to Deb Kemper, Managing Director at Golden Seeds Boston. Deb, it's absolutely fantastic to have you on the show. Thank you so much for joining me today.
Oh, you're welcome, Harry. Glad to be here.
Now, I'd love to start the episode today by hearing a little bit about you and how you made your way into the early stage investing game. So what was your entry point?
So my entry point was joining an angel group called Golden Seeds when we moved to Boston 3 years ago. So I long career in management consulting. That was the bulk of my career. And then we started moving globally, actually for my spouse. And I had to reinvent myself every place we moved, which was about every 3 to 4 years. And got into board governance, got into entrepreneurship via a very small NGO that we were doing a lot of different initiatives. And I started working with entrepreneurs in the sustainability space. And when I moved to Boston, the only way I could think of to try and tie all these threads together that made sense and also was exciting and interesting to me was to start looking at doing private investing. And kind of went and talked to a bunch of folks, friends that were VCs, and at the time, we moved in 2013. There was still a lot of contraction in the industry, but we had individual, in our own portfolio. We decided to take a percentage of our own portfolio and start making small investments. And so I just have loved it and gotten more and more entrenched in the ecosystem here in Boston. And just continue to find great companies to invest in.
And I'm really intrigued, when you started out then with that kind of capital pool, with the desire to invest in those startups, what did the strategy look like going in? Was there a kind of vertical specialization? Was there a founder specialization? Was there a geographic specialization? What was the thesis going forward?
The thesis going forward was initially, so I kind of had two prongs when I was in China that I started really pursuing, which was both clean tech and sustainability, as well as gender diversity. The first two angel groups I participated in managed to meet both of those. And so I would get really excited, and some of my early investments were women founders with sustainable or clean tech focused companies. And so that's what got me in. What happened though is there weren't a lot of those companies, and clean tech is a very challenging sector for early stage capital because a lot of them require a lot of capital farther down the line. And it just got challenging to find a lot of women-led clean tech companies. And so I realized I had to start diversifying my portfolio, and being a part of a group like both CDBG and Golden Seeds and now RBA is that you get to see a lot of different companies. And so I was able to get exposed to enterprise SaaS companies and realized, I should have more diversity in my portfolio. You start doing the research that says you need, a whole 10 to 20 investments to make sure you're going to get the big return. And I was able to start playing in both some later rounds, as well as some technologies that maybe were outside my expertise. But I was able to learn from others in the groups and my co-investors.
I'm intrigued in that respect. What did you look for in your co-investors that gave you confidence when you're investing potentially outside of your comfort zone?
You're talking about in the investments or investors?
In the investors themselves. What did they bring that gave you confidence in the investment?
So one, a lot more experience than me, right? So I was investing alongside people who'd been doing this for 10 plus years. And knew their way around term sheets, companies, industry, and had the industry focus. And so I was able to, I kind of use the term apprenticeship. I was able to be their apprentice, right, and ask a lot of questions and understand how to do due diligence, and really also rely on them and my own research of what were the trends. that were happening. So it's a bit of pulling, for me, why I love this is it's pulling information from a lot of different sources, but it was also then knowing that there were people who would say, nope, you know what, this is not, here are the issues with this that we can't get over. But it's a lot of trust. You have to really trust your co-investors and who you're going in with.
Can I ask, Deb, do you mind just making sure that the microphone doesn't rub against clothes?
Oh, yep. Here, I'm going to take my jacket off.
Yeah, no, absolutely. In terms of learning from those people, I completely agree with you. And we've seen a real rise of, I think you'll agree with me, in terms of Boston's startup ecosystem. What do you think has driven this rise of Boston's startup ecosystem, and how do you evaluate it now, today, investing in Boston?
So I think it's been driven by, say, three things, right? One is you had the long history here of biotech and tech in general, right? That these big firms had started here back in the 80s and earlier. So that was one. So you had a lot of expertise and knowledge, as well as folks that were willing to start new ventures. Two, you have a university ecosystem that is spinning out IP at an incredible rate, right? And it's not just the two that people would immediately think of, Harvard and MIT. It's BU, it's Northeastern, it's Tufts, it's, up at Dartmouth. It's just an incredible pocket of intellectual property development that goes on here across industries and sectors. And then the third is the accelerator network that's here. You've got Mass Challenge, you have Clean Tech Open in the clean tech space. You have a lot of different incubators like Bolt that are here that work with hardware companies. And I think that just really, they bring in a lot of mentors, and it just allows these companies to get the coaching that they need to get off the ground. And I think a fourth is that you do have a strong investor group. I mean, I think there's over 25 angel groups in Boston, and that's formal angel groups, never mind angel investors and people who will just invest on their own, without using a group to help them with the process.
And so many questions offshooting from that. But one this is the trouble being an interview. I could talk forever. But in terms of the IP you mentioned there coming out of universities, I'm always intrigued as to how important is IP for you when making an investment in a company? Do you think it's pivotal to have some kind of deep proprietary ownership over a technology? And also, is brand a form of IP if you build a strong enough brand?
Wow, there's a lot in that question.
That's a fully loaded question.
Let me try and unpack it a couple of different ways. I always think about intellectual property as not just being able to have something that's patentable. It's really about barriers to entry and building a moat, right? That's going to protect what you develop. So as an angel investor, where we're very early stage, we don't want to have something where we just have to be first, because the second person that likes the idea can potentially come in with more money and knock us out. And so there has to be something that is going to provide protection for this nascent company as it's starting. It could be relationships, it could be contracts, it could be channel partners, but it goes beyond just the intellectual property. If it is something that's really a patent and patentable, it is important that the science is sound and that it's something that, is backed, and it's not just that you filed for it, but that we actually will look at deep in the science and the background, the technical background. Is it really different enough that someone can't, again, try and work around your patents? And then it is the team and the time to market. Because you can sometimes have very early technologies that are really interesting and could go a lot of different ways. But then the question becomes, how much money are they going to need to do that? And as angel investors, do we have the appetite for that?
Do you think angel investors have a commitment to follow on in future rounds? So if you give money at kind of the earliest stages, do you have a commitment to the founder and the company to keep following on? Or do you think it's a kind of, not a one and done, but it's your choice whether to follow on?
I think it varies. Right. I think I don't follow on every round. I really have to understand why they're looking for the additional money. But I am finding, I'd say I'd have to look at my pro forma to see, but I probably follow on 60 to 80% of the time on companies, unless there's some major radical shift, or I just really think they're just not, they need more money than I can provide. And so they've got to find someone else who's buying into the pivot or where they're heading. I'm not sure I'm answering your question, but I think it's important for angels to understand that they need to follow on. I think if I had go back to my initial pro forma and rethink it a bit, now 3+ years in, I would say I should have allocated more money for follow-on rounds than I did initially. I did reserve for follow-on, but I probably should have reserved at a higher rate. And part of that's that you need money to carry companies through to like get their next round of financing. And then if they are doing well, you want to have the capital to double down when they're doing well.
Absolutely. But it's super interesting in terms of that kind of next stage of financing there and whether you follow on or not. I had Mike Maples discussion with Mike Maples the other day, and he said that often many follow-on rounds are not actually bridges, and that they're peers, kind of an endless road to nowhere. I'm intrigued as to your thoughts on this kind of potential pessimism towards bridge rounds, and to what extent you see them as a step to Series A or as an extension of potentially an idea that's not working and hasn't achieved product market fit. I asked really easy questions.
You asked really easy questions. No, there's a whole bunch of different tangents I could go on this, right? I think it depends. And so I guess you can see, I always see things in shades of gray. I'm not necessarily black and white. I think there's sometimes where it is a bridge to nowhere, and you're just trying to get them through to either get to a proof point or maybe get to a more reasonable wind down. Or sometimes it is to get them through, we've had some tough financing markets, right? It's very cyclical, and there can be boom and bust periods. There's times where money's chasing after deals, and there's times where people are really tightening their belt. And with the changing of the definition of Series A, I don't know if anyone's talked to you about this yet, but Series A's are really what used to be Series B's. These companies need more runway. And so I think it's understanding, if you're doing a bridge, why? Is it they really just need 6 more months to get to the proof point that's going to bring the next, the bigger round of capital? Or are they just really sputtering along? And it's hard if they are sputtering along to pull the plug, but sometimes that's what you have to do.
Would you recommend then Jeff Clavier's suggestion on runway as being essentially raise as much as you can at seed to avoid this potential bridge and to give yourself enough time to hit the traction points and the milestones that are required for the Series A? Or would you say stay to the 18 months and try and keep it as lean and constrained as possible?
I think if you can raise, I think it's within reason. I think if you can raise more, if you go, for $1 million and you can pull in 1.5, I would take the 1.5. I think that having the additional runway you need it, because things never go as planned. And I think a lot of startups focus so much on this fundraise, they don't actually think about then how are they going to spend it. I mean, everyone has what they're going to spend it on, but have they really thought through the metrics and milestones they're going to have to hit over the next, 3, 6, 9, 12 months? The downside of having too much cash is that sometimes they'll burn it in 18 months versus thinking about, hey, that should really get me 24 with that. And it's more of a rainy day fund versus it's just start spending faster.
Absolutely. Constraint enforces creativity.
Great. I would definitely agree with that.
Yeah. In terms of you said there about the metrics there, is there a kind of defined set of metrics that are required to make that transition from seed to Series A? Is there kind of commonalities you see in the successful companies that do make the fundraise successfully?
The biggest thing I'm seeing now is having product market fit and having recurring revenue. And the amount of recurring revenue can vary, right, depending on sector, because I see everything from life, except for life sciences. But even healthcare tech, you've got to start seeing market fit and recurring revenue. And the amounts vary, but it seems like the monthly recurring revenue that the Series A people want to see is more. And it's almost you have to have I think Series A, you used to not necessarily have to have recurring revenue. And now I think you do.
Absolutely. And that's probably due to the extension of the Series A to the Series B stage. No?
Right.
Yeah.
And then it has to be a lot more.
Good luck, founders. In terms of kind of those valuations at each stages, I'm intrigued. I'm always intrigued as to whether a valuation is an art or a science. So where do you stand on this important process at the early stage for you, and how do you look to evaluate whether a company is too highly priced or is a good price and right for you? What's your kind of thesis towards valuation?
So I think it's more art than science, because when you don't have revenues, it's hard to do any sort of a discounted cash flow. So for me, I look at the endpoint. I look at who's going to want to, what's my exit? How big is that exit going to be? Most likely. So what are multiples? What are those multiples going to be on? Is it on EBITDA? Is it on revenue, that someone's going to acquire this company for? And then I start ratcheting it back. So I don't like to invest, or I don't invest in anything at an early stage unless I'm going to get a 10 to 20x range, right? Hopefully you're going to have some that are more than that, but I have to, worst case scenario, it's got to be, minimum 10x worst case. And if I can't get there, so if someone's coming in, let's say with a 10 million valuation at a very early stage pre-revenue, it's crazy because I'm already losing, it should be around 2 to 5, and I'm already losing 2x right there.
Yeah.
And that's how I try to talk to entrepreneurs about it, that it's, think about, where you have to go and how much more money you're going to need to get there. It's important to not overprice yourself early, because then it's just going to make it harder on the later rounds. And another piece I see on this is companies that are coming in with a lower valuation are getting funded. It's the ones that come out of the gate too high that sit for a long time, even though the entrepreneurs may be willing to negotiate, but it just, at some point, it's better to say, I don't know, I threw a number out there, let's discuss, than to start out too high and then, you're automatically taking a 2x haircut.
Yeah, absolutely. In terms of the exit expectations that you mentioned there, do you think they're very different for you at the early stages, as the early stage investor you are, compared to the VCs at the Series A and on? Or do you think actually you still have the fundamental demand for $1 billion company?
I think I think we look more for $1 billion market, right? So then, or a growing market, right? It's not that I'm looking for a unicorn. Mm-hmm. I don't.
100 million exit in $1 billion market for you would be a great thing as an early investor in a 3 million round, but for a VC, it would be a bad thing when they're coming in at 30 million.
Exactly. Mm-hmm. Exactly. Right. So I think we're seeing stuff that the VCs are just saying it's too small a market for them, or they can't see how they're going to get to $1 billion valuation. Whereas we see companies that have solid businesses, real revenue, and could be I would even say a $50 to $100 million exit, right? You get a $2.5 million pre-money for a $50 to $60 million value, exit. That works out well.
Yeah, absolutely. No, that's a very welcome exit. I'd love to.
And a lot of corporate, and the piece of that as well is, looking at potential corporate acquisitions, right? That it's not necessarily about, I'd say in my portfolio, maybe I have one company I can imagine really going all the way to IPO, just a very, radical technology. But, I've got a lot that I can see getting, a $50 to $100 million exit.
As we said, welcome exit. In which case the mojitos are on you, Deb. But I'd love to dive into a quick fire round with you now. So I say a short statement and then you give me your immediate thoughts. How does that sound?
That sounds good.
So let's kick off with your favorite blog or newsletter.
Okay, this is really tough for me because I probably subscribe to 20 blogs and newsletters. I'd have to say I always make sure I check Crunchbase daily because it just tells me what deal flow is going on and keeps me apprised of very current deal flow.
Absolutely. And then in terms of biggest advice for an angel investor coming into the industry, what would you advise them?
Trust your gut.
Trust your gut. No, absolutely. And then this one is tough, so I apologize for this, but favorite book and why?
Oh, that's tough. I'd go with 7 Habits of Highly Effective People.
Okay, and why is that? What did you take from that? What can I use to make myself more effective from the book?
I just think it's a good refresher. So it's a book I read probably right when I came out of graduate school and when I started at McKinsey, and I listened to it on tape about a year and a half ago, and it's just a good refresher on how to treat people, how to think about business. I'm a big fan of win-win. And it really just helped me kind of refocus and think about things from how do you help the whole ecosystem thrive?
Have you read Adam Grant's Give and Take?
No, I haven't.
That is a must. Just genuinely, it's one of my favorites. And if you like that thesis of kind of how can we all win together, it is the best.
Great.
And then final one for you, and that's the most recent investment that you've made and why you said yes.
Okay, so it's in it's just happening right now. It's a SaaS enterprise software company. I can't say the name yet because it's not closed. But I said yes because it was an amazing team that I've been coaching for going on 9 months. And they can just see that this market is growing rapidly. And I feel like they're nimble enough to figure out how to get on the growth curve for it. And they're technical founders, so they have the technical capability to develop the SaaS platform that they need. And they're following the right paths and taking the right cues from the market. They also have, an early paid pilot, which makes it very attractive. So someone actually wants them to be doing what they're doing and is paying for them to develop it.
Deb, it's been absolutely wonderful to have you on the show. It really has been fantastic to hear about your journey and all the best for the future. I really appreciate you giving up the time today.
Great. Thanks, Harry.
And I'd like to give a huge hand to Deb for giving up her time today to appear on the show, and absolutely fantastic to hear her transition from management consultancies to rocking the early stage angel investing environment. And if you love the show today with Deb, then you can find more on SyndicateRoom.com, where there's a whole host of articles, resources, and more podcast episodes. As always, we so appreciate all your support and look very forward to seeing you next week.